Did you see? The stock market moved into correction territory. Now, of course, when you look at this, it simply makes a lot of sense. You got to understand, though, why. In today's video, we're going to show you why exactly the markets have moved the way they have, why this was actually quite predictable. And if you look at the intricate details, it makes a lot of sense. Okay. What we need to focus on, number one, overwhelmingly is liquidity, and that's a confusing term. People are trying to figure out what's going on. I thought we pay attention to earnings reports. I thought we look at what happens when Apple does their reports and they, give us information about how many iPhones they sold. The most important factor is liquidity. Overwhelmingly, there is no question about it. You do get fluctuations based on daily events and news. It could be something that happens halfway across the world, but no, we need to understand the money. Follow the money, and you will know exactly what's going to happen. You came here for the truth, so let me unveil that for you. My name is David Quinteri, and what I have been doing here at this channel for a very long time is looking at something which I now call the money mirror method. And with this, I'm able to simply indicate where the markets can move overall. Now, this doesn't happen on a daily basis. You can't look at that and say, I know where it's going to be in 1 minute from now. Of course, nobody can do that. But what we can look at is a general trend and have the absolute, wind at our back. The knowing the direction, giving us this information. It's all because of liquidity. Let's go through that, and I'll break it down here first. The new bull market is over. That's right, because the correction had come into play, and it depends on, of course, certain stocks are doing still reasonably well if they had good earnings and all these things. But let's look at the market. The summer rally in the stock market has ended, with the S&P 500 closing lower than it was on June 1st. The rally was driven by easing financial conditions, but now the Fed is committed to keeping rates restrictive. A return to summer highs seems unlikely in 2023. The tightening of financial conditions and rate hikes could lead to a contraction in the S&P 500 PE ratio, and that would be wiping out the summer gains, potentially pulling the S&P below 4,000. Now, this right here just tells us that the things that everybody has been watching, right? What has happened? Well, despite what's going on with earnings, with profits, all these things, these companies, their stock prices just kept going up and up and up. And the anticipation was that around September, the Federal Reserve was going to start cutting interest rates, or at least, the very least, they would say, okay, we're going to be starting to do that soon. Here we are. We're almost at the end of the year. And not only have they said and kept to their promise, believe it or not, that they're not going to cut interest rates, that it's not going to come for a while. Many people within the Federal Reserve have started to say end of 2024, so a year from now, or maybe even the following year, 2025, at least meaningfully. We don't know what's going to happen. Things could change in an instant, and then suddenly they just say, okay, we're going to cut. But the point is, this is where we are at right now today. And I have been staying consistent this whole time. Why? Because you can look at the information, leave the bias out of it. Look, I don't watch these things like CNBC and Bloomberg, and I don't follow particular people out there and try to get an analysis. I look at the charts, the technical analysis, and then I look at the raw data. Raw data, no bias on that raw data. So all I'm getting is information coming in, and I formulate my own conclusion. And I have seen the patterns forming day after day after day, and I've been doing this for a very long time. I don't have a bias because I've got nobody to listen to. I look at the data. Sure, it might be boring, but that's what I do, and I try to make it as interesting as I can, okay? I know we don't have Janet dancing here and everything, but I try to do my best. Your set it and forget it 401k made you rich, no more. Stock and bond portfolios that worked for the past 40 years aren't ready for what's coming because there is a big change going on right now. We know that, right? But what's this all about? The 60-40 split, people don't even deal with that anymore. Most people don't even have any bonds in their portfolio at all. So let's take a look. Well, we need to look in the mirror. Mirror, mirror on the wall, right? Well, not this mirror, a different kind of mirror. We have this, okay? We're going to look at the money mirror method. I've been talking about this for many years. I just recently called it the money mirror method, more recently anyway. And what we're looking at is, are they pumping cash out into the system or are they pulling it back from the system? What are they doing? And once we establish that, well, we know the direction of the market. And that is easier said than done because it's not just one indication. There are many. But we'll look at some of that right here now. All right. If you find this informative, if you could give that thumbs up, it does support the channel and we can help to promote these videos to others out there. All right. So looking at this is the Federal Reserve's balance sheet. They got a lot of assets. At one point, they had 9 trillion in assets. Can you believe it? Well, over a period of time, they've been selling off or letting them mature their treasuries and their mortgage-backed securities. And so that stuff that they had bought up, that is slowly but surely coming off. They got rid of about $1 trillion worth. And so we know that liquidity is being drained, but it can be made up for in other ways. Okay, so that's just one thing. This happens to be the number one factor. Are they doing quantitative easing or are they doing quantitative tightening? And right now, at this time, for over a year now, they've been doing quantitative tightening. So imagine, what's quantitative tightening? Okay, put a ball and chain around your leg or maybe a block of cement, however you want to do that, and you go overboard. And now I tell you, okay, go ahead, swim. Well, maybe you can. Maybe you're a super strong swimmer. You're Michael Phelps, right? And you can do it. You can keep up. You can keep up. But man, is that ever difficult. You've got that ball and chain. And so it's going to take a lot out of you. You're going to be expending much more energy to get the same result. That's quantitative tightening. The same with increasing interest rates. At this time, they have increased interest rates, not cut interest rates. Same analogy. You got the ball and chain, making it more difficult. Not impossible, just much more difficult. All right, that's one. Next thing, we're just looking at the bank term funding program. And what this is the emergency lifeline for the banks. So March, banks started to fail. You had SVB, you had Credit Suisse, all the rest. And so the Federal Reserve comes out and says, hey, we're going to set up this special thing. It's going to allow them to borrow money from our facility, whatever they need, they can have it. And now they are at $109 billion worth. This ends in a few months. What are they going to do? Like, where are they going to get this $100 billion suddenly from? They have to choose another avenue. And yet, slowly but surely, they've been using more of it. Okay? Interesting. So we know that there's a underlying problem inside of the financial industry. And that's because of this draining of liquidity. There's a problem here. So we got to start to see that. And I give you this as a piece of evidence showing you that it's not just about stocks and their performance and how many iPhones Apple's selling. There's something else deeper. At the Money GPS, I'm unwilling to give you, look, here's how many iPhones, here's how many MacBooks, here's how many iPads. Why would I do that? Okay, I'll leave that for the channels that don't matter. But on this channel, you get the deeper level. So we peel back those layers of the onion so that we can understand what's actually happening. I try to make it as simple as possible, analogies and so on, making it easy. And this is one of the core aspects of the money mirror method, okay? Now, obviously, when I go into these big, long descriptions and rants on my live session, you get the full detail. I'll try to be as succinct as possible here. This is showing us the S&P 500, okay? Just think about that. This is the U.S. stock market, the green line. And then we had the red line, which is the U.S. reserve balances with Federal Reserve banks. And what that means is, imagine like the commercial banks, they can keep their excess reserves at the Federal Reserve. And okay, that's always in flux. But in general, these two things, the stock market and the reserves, tend to be very correlated. Now, a few months ago, when we had this surge in the stock market, there was a chasm in between these. And I was highlighting this over and over again. I did it here, but also we had seen within my group talking about this. Hey, everyone, we got to see one of two things. The stock market has to come down, the reserves have to go up, or they got to meet in the middle. Those are the things that have to happen. And so what have we seen? Well, the reserves in general have gone up a little bit, at least from many months ago. But the stock market, that has come down considerably. And so it was very clear, it was very obvious that when we look at the amount of liquidity that had been drained from the system, and we understand the correlation between the money mirror method and just looking at the markets in general, things have to revert to the mean. Now, that doesn't mean that the stock market goes and crashes all the way down to the ground. That's not what I'm talking about. But when it gets ahead of itself, it certainly has to take a breather. It has to pause. Always. Nothing goes up forever. You see? And so that's what the money mirror method is all about. And I think it has shown to be highly accurate. And this is what, I want to be recognized for. I want to tell people that these things right here are a little bit more simple than they are made out to be. But each and every day there's noise. If we kind of take away that noise and we can look beyond it, then suddenly it makes a lot of sense. You see it here on this chart. It is very clear and obvious. All right. So they basically met back up, and who knows, it might take off from here. Absolutely could. But the point is, time and time again, this proves to be accurate. And so what do we have? What can we take away from this? Number one factor, we must look at liquidity. Before you buy anything, before you buy any stocks, before you get into any investment, you have to know a few things. Are the insiders buying or selling? That gives you a little inside scoop. Are the central banks printing money, or are they taking it away? We have to understand that on multiple levels. That's in terms of like the quantitative easing, quantitative tightening, also the interest rates. Look at what's called financial conditions. That gives us an idea of, are we moving more tight or are we moving looser? Because that's based on many factors. It's not just like how much quantitative easing there is or just the interest rates. There's like many, many factors, financial conditions. And, what I would want to look at is any other factor I could find around the broad indices, not going down to the stock level yet. We don't want to get there at all. We want to understand overall, what's happening overall. If I have confidence overall, then I can come down to the sector level and understand, okay, what's happening with tech right now? Okay, that's happening with tech. Okay, great. Okay, I'm good for tech. Now I can go down to the corporation level. I call this the paratrooper trading strategy or investing strategy. And that's important. If you want to get part of this group where on the Friday session, we talk about looking at the market, the economy. I prepare a presentation. Within that presentation, this is kind of something you'll see in those presentations. Just talking about, in this case here, what can you look at with Apple and China? So I might take a piece of news that I found during the week and we could learn a little bit from that. And then I just a couple points here, and then I get into it, like what it all means and what you can do as, in those videos and in those sessions, which go, by the way, for like 2 hours every time. I'm able to be a lot more, I don't want to say honest, but I can be, more descriptive. I can just tell it like it is. I don't need to worry about algorithms and this and that. And so I definitely appreciate the group that's there. So that's the Friday session. And then the Sunday session, we talk about how to make money. We look at e-commerce. We look at selling stuff online, selling services, how you can make money today, how you can make money more long-term, all those things. That's the Sunday session. So if you're interested in either one, there's going to be a link in the description which is what I call the mentorship, but ultimately it's just a way that's the term that I used initially when I set it up, but now we've split into two factions. And so if you're interested in that, on either one of those, let me know. Link in the description. I want to appreciate you for being here today. If you want to know more, you let me know. But thank you very much. And of course, tune in tomorrow. I got some really good info about what's happening in the economy. All right. I'll see you then. Take care.